Welcome to our deep dive into the world of primary markets. In this video, we'll unravel the essentials of how companies raise capital directly from investors, why this process is called the new issue market, and what makes it so critical for both businesses and the broader economy. Whether you're a student, investor, or just curious about financial markets, understanding the primary market is a foundational step. We'll explore its definition, core functions, the roles of various participants, and how it differs from the secondary market. Let's begin by setting the stage for what the primary market is and why it matters. Primary market is where companies or governments raise fresh capital by issuing new securities, such as shares or bonds, directly to investors. This is the first time these securities are available for purchase, which is why it's often called the new issue market. Investors buy directly from the issuer, providing funds that help businesses grow or governments fund projects. The process is also known as going public, when a company offers shares to the public for the first time. This market is essential for economic growth, as it channels savings into productive investments. Issuers in the primary market are typically companies or governments seeking to raise funds. For companies, this might mean expanding operations, launching new products, or paying off debt. Governments may issue securities to fund infrastructure or social programs. These issuers work closely with intermediaries like merchant bankers, who help structure the offering, set the price, and manage the process. The goal is to attract a broad base of investors, ensuring the issuer gets the capital it needs while offering investment opportunities to the public. Merchant bankers play a pivotal role in the primary market. They assess whether a business is ready to raise capital, help design the security to be issued, and determine the right price. They also identify potential investors and manage the entire capital-raising process. Merchant bankers may arrange for a syndicate of investors or secure underwriting services to ensure the issue is successful. Their expertise helps issuers navigate regulatory requirements and market complexities, making them indispensable in the primary market ecosystem. There are several ways securities can be issued in the primary market. The most common are public issues, rights issues, and private placements. Public issues involve offering securities to the general public, while rights issues are made to existing shareholders, giving them the chance to buy more shares. Private placements target a select group of institutional investors. Each method has its own process, advantages, and regulatory requirements, allowing issuers to choose the best fit for their capital needs. Public issue is when a company offers its securities to the general public for the first time. This process is commonly known as an initial public offering, IPO. The company must meet strict eligibility and disclosure requirements set by regulators. The public issue process involves preparing a prospectus, setting the price, and distributing the securities through a network of brokers. This method helps companies tap into a wide pool of investors and raise significant capital for growth. Rights issue allows existing shareholders to purchase additional shares, usually at a discount, before the company offers them to the public. This method helps companies raise capital while giving current shareholders the opportunity to maintain their ownership percentage. Rights issues are often used when a company needs to raise funds quickly or wants to reward loyal investors. The process is typically faster and less expensive than a public issue. Private placement involves selling securities directly to a select group of institutional investors, such as banks or investment funds. Unlike public issues, private placements are not open to the general public and often involve fewer regulatory requirements. This method is faster and more flexible, making it ideal for companies seeking to raise funds quickly or maintain confidentiality. Private placements can involve either debt or equity securities, depending on the issuer's needs. Pricing of securities in the primary market is a critical step. For public issues, the price is often determined by demand and supply dynamics, sometimes through a book-building process. In the case of government securities, pricing is typically set through auctions where institutional investors bid for the securities. The final price reflects market sentiment and ensures fairness for both issuers and investors. Proper pricing is essential to attract investors and ensure the success of the issue. The primary market operates under a strict regulatory framework to protect investors and ensure fair practices. In India, the Securities and Exchange Board of India, SEBI, regulates the primary market for equity and corporate bonds. The Reserve Bank of India, RBI, oversees the issuance of government securities. Regulations cover eligibility norms, disclosure requirements, and the roles of intermediaries. This comprehensive oversight helps maintain investor confidence and market integrity. Issuers must meet specific eligibility criteria and provide detailed disclosures before raising capital in the primary market. These requirements ensure that only credible companies can access public funds and that investors have all the information they need to make informed decisions. Disclosures include financial statements, business plans, risk factors, and use of proceeds. This transparency builds trust and helps prevent fraud or misrepresentation. One of the key functions of the primary market is to help issuers tap into larger pools of capital. By reaching out to new investors, companies can raise more funds than relying solely on promoters or banks. For example, an Indian company issuing global depository receipts, GDRs, can attract international investors, expanding its capital base and global presence. This access to broader markets is vital for business growth and competitiveness. Primary market fosters competition by allowing securities to be priced based on market demand and supply. For instance, government securities are often sold through auctions, where institutional investors bid for the best rates. This competitive process ensures fair pricing and efficient allocation of capital. It also encourages issuers to offer attractive terms to investors, benefiting both parties and enhancing market efficiency. When a company issues new shares to the public, it diversifies its ownership structure. Existing shareholders, stakes are diluted, and new investors become part owners. This broad-based ownership separates management from ownership, leading to professional management and improved governance. Publicly held companies often appoint independent directors to represent small shareholders, further strengthening governance standards and protecting investor interests. Raising capital from new investors requires companies to meet higher standards of disclosure and transparency. Investors need accurate, relevant, and verifiable information before making investment decisions. The primary market enforces these standards, ensuring that companies provide detailed financial data, business plans, and risk assessments. This transparency builds investor confidence and helps maintain the integrity of the market. The primary market, information provided by issuers is scrutinized by a wide range of investors, analysts, and researchers. This collective evaluation acts as an additional layer of scrutiny, complementing the work of auditors and regulators. Publicly disclosed financial statements and prospectuses are analyzed and discussed, helping investors make informed decisions and promoting accountability among issuers. The primary market provides an exit route for early investors, such as promoters or venture capitalists, who supported the company in its initial stages. By selling their shares in a public offering, these investors can realize profits and reallocate capital to new ventures. This exit mechanism encourages investment in startups and early-stage businesses, fueling innovation and entrepreneurship. When securities are issued to a large number of investors through the primary market, they become more liquid. Listing on a stock exchange allows these securities to be freely traded in the secondary market. This liquidity benefits investors, who can buy or sell their holdings easily, and enhances the attractiveness of investing in new issues. It also supports efficient price discovery and market stability. Every step of the primary issue process is subject to regulatory supervision. This includes the issue process, roles of intermediaries, and disclosure norms. The aim is to protect investors who may not have direct control over the business. Regulatory oversight ensures fair procedures, accurate information, and well-defined rights for all parties involved. While returns are not guaranteed, these safeguards help maintain trust in the market. After securities are issued in the primary market, they are listed on stock exchanges and become available for trading in the secondary market. The secondary market allows investors to buy and sell securities among themselves, providing liquidity and flexibility. While the primary market raises capital for issuers, the secondary market enables investors to exit or adjust their holdings. Both markets are essential for a healthy financial ecosystem. The secondary market, investors trade securities with each other, independent of the original issuer. Prices are determined by supply and demand, reflecting the company's performance and market sentiment. The secondary market does not provide new capital to the issuer, but offers liquidity to investors. It also serves as a barometer for the overall health of the financial markets and influences pricing in the primary market. Performance of securities in the secondary market provides important signals for future primary market issues. If similar stocks are performing well, it can boost investor confidence and help issuers price new offerings more attractively. Conversely, weak secondary market trends may make it harder to raise capital. Thus, the secondary market acts as a feedback mechanism for the primary market. Government securities are issued in the primary market through auctions managed by the Reserve Bank of India. Eligible participants, such as banks and primary dealers, bid for these securities. The auction calendar is predefined, and the process ensures transparency and fair pricing. Government securities are a key tool for managing public finances and providing safe investment options for institutions. Companies can issue bonds in the primary market, either through public offers or private placements. The Securities and Exchange Board of India regulates these issuances, ensuring that companies meet eligibility and disclosure norms. Corporate bonds provide an alternative to equity financing and are attractive to investors seeking regular income. The process is designed to balance the interests of issuers and investors. Indian companies can issue depository receipts, such as American depository receipts, ADRs, or global depository receipts, GDRs, in foreign markets. These instruments allow companies to access international capital and diversify their investor base. SEBI regulates the issuance of depository receipts, ensuring compliance with foreign investment limits and disclosure norms. This helps Indian companies expand globally while maintaining regulatory oversight. Variety of intermediaries participate in the primary market, including merchant bankers, brokers, underwriters, and registrars. Each plays a specific role in ensuring the smooth execution of security issuances. For example, underwriters guarantee the sale of securities, while brokers distribute them to investors. These intermediaries are regulated to ensure fair practices and protect investor interests. Underwriting is a process where intermediaries commit to buying unsold securities in a public issue. This guarantees that the issuer will raise the intended capital, even if investor demand is low. Underwriters charge a fee for this service and take on the risk of holding unsold securities. Their involvement adds credibility to the issue and reassures both issuers and investors. Securities in the primary market are distributed through a network of brokers and intermediaries. This network ensures that offerings reach a wide range of potential investors, maximizing subscription and capital raised. The distribution process is carefully managed to comply with regulatory requirements and maintain transparency throughout the offering. Investor protection is a cornerstone of the primary market. Regulations require issuers to provide accurate and complete information, and intermediaries must follow fair practices. Regulatory bodies monitor the process to prevent fraud and ensure that investors' rights are safeguarded. This focus on protection helps build trust and encourages wider participation in the market. Wrap up, the primary market is the gateway for companies and governments to raise fresh capital, fueling growth and development. It operates under strict regulatory oversight, involves a range of intermediaries, and offers multiple methods for issuing securities. The functions of the primary market, such as tapping larger markets, fostering competition, diversifying ownership, and ensuring transparency, are vital for a healthy financial system. Understanding these concepts helps investors make informed decisions and appreciate the role of capital markets in the economy.